With Tesla's earnings out this upcoming week, let's take a quick look at something that the market might be overlooking. In Q4, net income was impacted by the recognition of a one-time non-cash benefit of $5.9 billion. In other words, income tax provision for Q4 was $5.9 billion higher than what would have otherwise been $148 million. This recognition increased diluted earnings per share from what would have been 0.58 to 2.27, a difference of 291%. Not only that, but starting in Q1, Tesla's book tax rate will now be more in line with other companies in the S&P 500. This will be roughly doubling compared to what we've seen for Tesla over the past 3 years. The reason for this increase is because Tesla was not profitable for so many years prior to breaking even. And when a company is not profitable and then later becomes profitable, the losses can be used to offset future taxable income known as a tax loss carry forward. And as far as the Q1 results go, we have a rough idea of what to expect thanks to Tesla's production and delivery release. Total production decreased 2% year over year and 12% quarter over quarter, with total deliveries decreasing 9% year over year and 20% quarter over quarter. For the first time, Tesla has also included megawatt hours of energy storage deployed, which came in at 4,053 megawatt hours, an increase of 4% year over year and 27% quarter over quarter. So putting these numbers together can give us a rough idea of what to expect for the earnings. Consensus estimates for earnings per share is at roughly 50 cents. With the understanding of why Q4's diluted earnings per share was at 2.27 rather than what would have otherwise been the 0.58 without that one-time adjustment, the change from Q4 to Q1 will simply read as a quarter-over-quarter earnings decline of 78%. Now, you and I understand this, but if you're unfamiliar with why Q1 is going to read like a 78% earnings decrease quarter over quarter, others, including trading algorithms, might not read this the same way. With an earnings per share of 50 cents, this puts Tesla's PE ratio around 75. This is a step change higher compared to other benchmarks. On top of that, revenue growth has virtually stagnated since mid-2022, and we've been seeing a shakeup in core management as well as mass layoffs, and now we have rumors of the cancellation of the NV9 project, aka the $25,000 version of the Gen 3 platform. Now, I'm not going to make any sort of short-term price prediction for Tesla stock. This video is merely food for thought. But with Tesla's FSD seemingly closer than ever, and the Robotaxi reveal right around the corner, it's going to be interesting to watch how Tesla stock reacts over the next several quarters. For those unfamiliar with what kind of impact a Robotaxi network would have on Tesla's valuation, check out the video in the description below. The implications for a Robotaxi network are a game changer. In closing, things will continue to be choppy for Tesla stock in the short term, but in the long term, it's probably just going to be a blip on the radar. What are you expecting from Tesla this week? Be sure to leave a comment below, and to support the channel, be sure to check out the Patreon in the description below, or simply leave a like. Thank you for watching. I'll see you in the next one. Have an awesome day.